This video talks about currency risk, some locations in which currency risk can occur, as well as how derivatives can be used to manage some of that risk. So currency risk pops up all over the place, and when we're talking about currency risk in the context of doing business, there are three different types: transaction, translation, or economic or operating risk. Transaction risk occurs because when you do business with someone outside of the country, typically they want to get paid, or they will pay you in their own country's currency. And so there's a risk in receiving a currency that's not your own because you don't know what that currency is going to end up at when the customer finally pays, or when you finally pay the client. You might book an order today with a supplier, but you don't actually have to pay the supplier until, often say 90 days later. And so you agreed about the price today, about how much you were going to pay, and that may be some amount of dollars today. But if you're paying in, say, Japanese yen 90 days later, you don't know what the value of the Japanese yen is going to be. So you don't know how many dollars it's going to cost you ultimately. And that's transaction risk. Transaction risk is really the biggest risk that companies face when it comes to currency risk. Now, there is this thing called translation risk, and that's a little bit different. It's material, but it's not as big of a risk. And translation risk is that when you're an international company, maybe you have your headquarters in the USA, but you also have subsidiaries in a couple other different countries. And so the thing is that when you have these subsidiaries, these companies that you own operating in other countries, they have their own currency. They'll have customers paying in this currency. Costs will be based in that currency, and that's fine. You can still run a business that way. But with translation risk, there's this risk that what your company is worth on a year-to-year basis, at least on paper, changes because when you go and figure out at the end of the year what total assets are, say, in your subsidiary in France, then you tally up the total assets in, say, euros. But when you convert that, you don't actually exchange currency, but when you value those European assets in terms of dollars at the end of the year, that will change based on whatever the euro to dollar exchange rate is at the time. And then the same thing with the Japanese yen here on the left. So that's translation risk. And it's less of a big deal just because it doesn't really impact the bottom line. It definitely impacts valuation, but investors often look beyond that temporary fluctuation in valuation as a result of currency changes. What is more a big deal and is difficult to hedge, even with the derivatives that we look at, is something called economic currency exposure, sometimes called operating exposure. And this is the risk in the risk of a change in the competitive landscape due to currency movements. So you might be, again, operating in the US as a company, but your competitors might be based all around the world, and their expenses are in different currencies. And so The risk is that if this is a globally competitive market, that customers will buy from just wherever it's cheaper, then if the currency of one country decreases in value, then all else being equal, those goods that are produced by this company become cheaper, and that shifts demand away from these relatively more expensive products because they're in stronger currencies towards purchases to where the currency is cheaper. And this can be a very contentious issue and a very real one, but that's economic exposure, economic risk. The risk that currencies change one way or another, and it affects demand for goods that are denominated in that currency. So translation and economic exposure, you can't really use derivatives to hedge, at least not cost effectively. But transaction exposure, that we can do something about. For hedging transaction exposure, the most common methods are to use currency forwards or to use currency futures. Like we've seen before, the difference between forwards and futures, one for the currency market in particular, the currency forward market is quite large relative to some other forward contracts we've looked at. There's a large, well-developed, and old market for trading currencies in the forward market, the OTC or bank-to-bank market. And the nice thing about trading in the forward market of getting a contract by going directly to a bank is that it's customizable. You can get a very specific dollar amount of exposure for another currency with a very specific timeline in mind. That's not the case with currency futures. Very liquid, very easy to trade, but on the other hand, not so customizable. You'll be stuck with a specific maturity and a specific notional amount, just like you've seen when you've traded futures of other types of assets besides currencies. With either one of these, though, the concept is essentially the same. If, for example, we're trading currency forwards to eliminate some transaction exposure, what's happening is that we book an order today. Let's say we're hedging out transaction exposure today, where we agree today to buy, say, a specific yen amount of tires in 6 months. So we're a US company. 6 months later is the date where we actually transact money for this purchase from our supplier. The thing is that today we agree about how much we're going to buy. Say, not in dollars because this is a Japanese supplier, but 100 million yen worth of tires, and then they'll ship it to us, but we don't actually pay until 6 months later. And so the risk is that we just made a commitment to pay for something in yen 6 months from now, and the Japanese yen can change in value significantly between now and then. And so this type of risk is the risk that we'd like to eliminate with the currency forward. And it's fairly easy to do because we know exactly how much risk we have. We need to buy 100 million yen 6 months from now. And so what we can do is, as soon as we book this order, then today we go to a bank and buy a currency forward contract. We buy that amount of yen forward at a specific exchange rate. And the pricing of this it depends, it gets a little complicated, but let's say the forward rate is 115 yen to the dollar. What happens is that if this is a 6-month forward contract, then after 6 months go by, I'm still on the hook for paying this 100 million yen to the supplier. But the thing is that I'm going to go to the bank and in 6 months' time go to the bank and say I'm ready to buy 100 million yen. And the exchange rate for that is going to be 115 yen to the dollar. So at the end of 6 months, I'm going to buy 100 million yen from the bank, and it's going to be at an exchange rate of 115 yen to the dollar. So in dollar terms, it's going to cost me $869,500. But that's the nice thing. I know exactly how many dollars it's going to cost me, and I figured it out right up front because of this forward contract. I'm paying $869,000 to the bank. They're giving me, as agreed, 100 million yen. This is at 6 months' time. And I turn around and pay that 100 million yen to my Japanese supplier to pay for the tires. And so mechanically, it's a 1-for-1 hedge. There's only 2 transactions going on. And that's that. The only thing I need to be aware of is whether I'm buying yen forward or if I'm selling yen forward. Here I'm locking in the right to buy because I need to pay my supplier in yen. If this were my customer and they were agreeing to pay me yen 6 months later, I'd want to instead lock in the right to sell yen forward. However much they're paying, I want to lock in the right to transfer that from yen into dollars at a pre-specified rate. Currency futures, the idea is exactly the same. It's just that with futures contracts, we still have these 2 things. We have the underlying transaction. Here, it was the Japanese tire supplier, and the payment that we had to make was in foreign currency. The risk is that the currency gets expensive. If the Japanese yen increases in value, it's going to cost me more dollars to buy that same amount of yen. And so the idea is that we buy an offsetting futures contract that will profit in that type of scenario. For example, if I'm afraid of appreciation of the Japanese yen, I would want to go long a futures contract on the Japanese yen. Because in that case, the futures contract would profit if the Japanese yen increased in value, and that profit would go to offset the higher cost when ultimately I convert dollars into yen to fulfill this underlying tire purchase. So it's the same idea, it's just that the mechanics, I'm not just kind of going to the bank to solve my problem. I'm using futures mechanics to eliminate that currency risk. The last thing to discuss here is how to manage the foreign exchange currency risk of an equity portfolio. A equity portfolio that's based in another country will be denominated in a different currency. Of course, you can buy an ETF that's based in the US, that's on another country, and you're still buying it in terms of US dollars. But if you actually try and go buy equities yourself out on another country, on another country's exchange, that purchase will be denominated in that country's currency. And so that's where this type of scenario comes in handy. But one thing to know is that, well, basically, it's very difficult to hedge the currency risk of an equity portfolio. And that's because you don't know what the value of that portfolio is going to be in the future. And so when it comes time to hedge, you don't actually know, you can't know how much to hedge. Here in this example, we were buying and selling underlying physical goods, and we were hedging out that currency transaction exposure. Here we were buying tires, and we knew exactly how much exposure of yen that we had. But with here, we don't know what the value of this portfolio will be in 6 months. And so we don't know how much to hedge. I mean, one thing we can do is just hedge a minimal amount. Say, for example, if you knew that the portfolio would, or that at least it was extremely unlikely that the portfolio would lose more than 70% of its value, then you can at least hedge that bottom 30% of the portfolio. But that still leaves a lot of risk to try and eliminate, and you just can't, because you don't know how much risk to hedge out. And also, there is another argument for actually not hedging at all, at least when it comes to hedging the currency risk of an equity portfolio. One is that, it's costly to hedge. You still have to pay money, although futures aren't that expensive. But the main reason for this is diversification. Let's say you invested in 2 international equity indices, and they both performed relatively the same. It's just that maybe the differences weren't really due to the equity returns, it was just due to currency fluctuations. And if you had invested in these 2 together, there's this diversifying effect. If you put half your money in one, half your money in the other, you notice that sometimes one goes up while the other goes down, and vice versa. They always trend up, but they don't trend up at exactly the same pace. And that is the benefit of diversification. You're actually getting some diversification because of this currency fluctuation, and because of you investing in more than one currency. And so you may not want to hedge at all, because currency exposure provides that diversification. And so the only way really that you can hedge out fully the currency risk of an equity portfolio is to also hedge out the equity risk of the portfolio. And we've seen that before. If you know the beta of a portfolio, you can measure how much it moves in proportion to the overall market. And you can remove that beta by finding offsetting futures contracts. But that's going to do this to your portfolio's performance. You'll have great volatility in terms of very low volatility, but you also have terrible long-run returns. Much more muted returns. So if you can eliminate the market risk of the portfolio, then you know just about what you're going to end up with at the end of this duration of the futures contracts you're hedging this equity portfolio with. And if you know that, then you can also hedge out the currency risk too, because now you know what it's going to be worth in the future. But it's almost kind of pointless to do that. If you want to temporarily eliminate your equity exposure in a foreign market without having to actually sell it, then this is a way to go. But from a long-term perspective, it's not really a useful strategy to pursue, because it results in, the elimination of risk, but also almost the complete elimination of return as well.